Welcome to this week's Market Intelligence Explainer. The headline driving everything on the desk right now is this: we are transitioning risk on, but we're doing it within a late cycle macro overhang. We've got a moderate growth, cooling inflation regime, but, and it's a big but, it's sitting right on top of some major geopolitical fault lines. So, our mandate today? It's risk first. We absolutely have to focus heavily on these underlying structural drivers before we even think about chasing any upside. To really frame this, let's look straight at the numbers anchoring our trading desk this week. We're looking at a Shadowfox risk score of 63, alongside a conviction score of 58. Now, what exactly does that tell us? Well, it means participation is completely warranted. The breadth we're seeing across the US equities market is actually consistent with a durable uptrend. It's not just a top-heavy mega-cap rally. But that conviction score of 58 means we're not maxed out. We have to be surgical. This isn't a blind buy everything market. This is a benchmark that demands tactical precision. So, what's the primary catalyst giving us that 63 risk score? It's the June headline CPI dropping in the US down to 3.5%, which establishes a very clear structural disinflation narrative. Core CPI is running at 2.6%, and because of this, the Fed decided to hold rates at their late July meeting, explicitly stating they're maintaining ample reserves. So structurally speaking, we're in an environment where liquidity isn't drying up and inflation is moving in the right direction. That gives risk assets the green light to breathe. But here is where the debate on the desk really heats up. Yes, the structural macro mandate points to a moderate growth regime, but tactically, we are seeing major risk markers firing under the hood. The primary driver of immediate risk isn't necessarily the Fed's target rate anymore, it's Treasury liquidity. If we see even a minor hiccup in Treasury auction demand, that entire structural mandate gets stress-tested instantly. We literally cannot ignore the tactical plumbing of the market just because the headline inflation number looks friendly. Okay, let's dive into this, because understanding that plumbing is absolutely crucial. We have to look at term premia. In simple terms, that's the extra yield investors demand for holding longer-term bonds instead of just rolling over short-term ones. Right now, term premia dynamics, along with contained policy uncertainty, are actually helping to loosen financial conditions. The market basically believes the Fed is done hiking. That contains the front-end uncertainty, which allows longer-duration assets to catch a bid. And that is the structural tailwind keeping financial conditions relatively calm. Calm on the surface. Maybe, but contrast that with the glaring divergence between equity volatility and rates volatility. The VIX is sitting subdued, right in the mid-teens. Equity markets look like they're asleep at the wheel. But the MOVE index, which tracks bond market volatility, remains elevated compared to pre-energy shock norms. Guys, this is the critical threat. The options market and rates is pricing in potential fireworks. If that Treasury auction demand falters or term premia violently reprice, the MOVE index is going to spike and it will drag that sleepy VIX right up with it. Which brings us to how we actually trade this environment using volatility bands. These bands help us define the current regime. Because the VIX is in contango, meaning short-term volatility is priced lower than longer-term, this specific regime favors strategies that harvest risk premia. Essentially, you can sell short-dated volatility, expressing the view that policy and term premium containment will hold. But, and listen, this is a massive but, you must size these trades specifically around known macro events. You don't just blindly sell vol, you harvest it carefully between the catalyst windows. Right, and here is the so what for anyone managing actual capital right now. This is the Shadowfox kill switch matrix. When does this entire Goldilocks setup fall apart? The kill switch triggers if two things happen simultaneously. First, inflation data reverses and re-accelerates, likely driven by an energy or geopolitical shock, and second, that is immediately followed by sudden credit spread widening. If high-yield spreads blow out while inflation spikes, the regime flips from moderate growth to a stagflationary crisis instantly. That's the exact scenario where you cut exposure immediately. With that systemic risk mapped out, let's pivot this explainer over to strategy. Section 1, the tactical playbook, where we're balancing core ballast versus swing trades to avoid those euphoric breakouts. Let's walk through the terminal-grade flow map to see those setups in action. For the tactical book, the mandate is strictly participate, don't chase. Top of the list is the QQQ versus IWM spread. We're heavily favoring large-cap growth, the Qs, over rate-sensitive small caps. Why? Because in a moderate growth, cooling inflation regime, large-cap margins are highly durable. Small caps, on the other hand, are incredibly sensitive to the credit and funding wobbles we just talked about. If the MOVE index spikes, IWM gets hit the hardest, so stick to the large cap secular drivers. Another structural setup we're watching closely relies on understanding beta, the measure of an asset's volatility relative to the broader market. We are looking at a euro area quality versus US cyclical setup. We are advising the desk to avoid pure energy beta. While energy prices could totally spike due to geopolitical risks, pure energy exploration equities carry way too much volatile beta. Instead, we favor euro area defensives. They offer a much smoother ride as European inflation cools, acting as a solid ballast without the wild geopolitical swings of pure energy plays. To deliver some concrete takeaways for the tactical book, your trigger right now is to add to the U.S. large-cap tech and AI basket. Think names in XLK and SMH. But here is the discipline you need. You only add on macro-driven pullbacks that do not break the disinflation narrative. If the market sells off because of a scary headline, but the underlying inflation data is still cooling, you buy that dip. But if inflation reaccelerates, you sit on your hands. Confidence on this trade is high, provided the structural narrative holds firm. All right, let's move to Section 2, the watch list, looking at upcoming market catalysts over the next 7 days. Because in this regime, macro catalysts matter far more than individual company earnings. Here are the critical volatility pockets you need to navigate this week. First, we have Bank of Japan speeches. Watch closely for hawkish leanings that could spike yen volatility. Then we have the ongoing Fed rhetoric. Remember, 3 FOMC members dissented and actually wanted a hike, so any speeches from them could seriously rattle the rates market. From there, we roll into Euro HICP inflation data, and we cap the whole week off with U.S. labor data. Those labor prints, alongside ongoing Treasury auctions and AI CapEx guidance from tech bellwethers, are the absolute catalysts that will either confirm our moderate growth regime or trigger that kill switch. Which leads us to the narrative pressure index. What is the market pricing in? And more importantly, what is it ignoring? Right now, markets are heavily overweighting the bullish AI productivity and disinflation narratives. It is providing massive upward pressure on tech and large caps. But dangerously, the market is broadly underweighting the bearish vectors, specifically geopolitical escalation and energy shock tail risks. The market is priced for absolute perfection on the macro front, which means any left-tail geopolitical event will have an outsized, violent impact on pricing. Which brings us to the network mandate to close out this week's briefing: protect capital first, opportunity follows survival. With the VIX asleep and the MOVE index flashing warning signs, this is absolutely not the time to be a hero on margin. The liquidity transition is happening, and the structural setup is healthy, but the tactical plumbing requires your full, undivided attention. So as you look at your own positioning this week, ask yourself one provocative question. If the kill switch triggers tomorrow on an unexpected inflation spike, is your portfolio built to survive the transition, or are you just blindly chasing the beta? Thanks for joining us on this explainer. We'll see you next time.